Most bookkeepers don't mess up because they're bad at accounting. They mess up because they're answering the wrong question when they categorize transactions. And once you see this, categorizing gets way easier. The real goal. Let me make a bold claim real quick. Categorizing transactions is not about being technically correct. It's about making books answer questions fast. Common myth right out of the gate? There's one category for every transaction. Nope. In reality, there's usually something like 3 acceptable answers and 1 useful answer. Think of categories like folders on your computer. If every file is perfectly named, but you can't find anything when you need it, the system failed. So the real goal is simple. When someone looks at the reports, they should immediately understand what's going on without asking you follow-up questions. That's it. That's the job. And this changes how you categorize everything. What you actually need. At a minimum, every transaction needs 4 things: date, amount, money in or money out, from or to, the vendor or the customer, and what it's for, the category. That last one is where people freeze. Here's the shortcut. Pretend you're explaining the transaction to a friend who knows nothing about accounting, not office expenses, but, oh, that was monthly software we used to run payroll. That's the mental model. Now, quick mistake I see all the time. People rely on the bank description. Bad idea. Banks truncate text. They abbreviate. They remove context. Instead, always look for the full bank text if you can. Then stack clues. Recurring amount, probably a subscription. Recurring date, even more likely. Nice round numbers like $9.99 or $49, subscription energy. Seen it before? Check how it was categorized in the past. And if you're using something like QuickBooks Online, consider using the match feature. It's not magic, but it might save you from reinventing the wheel. Also, super underrated tip, get view-only access to bank and credit card accounts. Why? Because sometimes you can see things like check images, memo lines, or details that never hit the feed. Those clues are gold. Third, smart categorizing clues. And here's where most people either overthink or underthink. They create millions of categories just in case. But here's what nobody tells you. Categories should be driven by questions, not perfection. Before adding or changing a category, ask, what do I want to be able to see quickly? Examples, how much do I really spend eating out? Separate dining out from groceries. What does my car actually cost per month? Fuel insurance repairs, grouped intentionally. What's the true cost of this hobby? One subcategory per major hobby. If a category doesn't answer a question anyone cares about, merge it. Your report should feel like a dashboard, not a dictionary. Another pro move, mirror income and expenses where it makes sense. If someone has salary income, side gig income, rental income, then parallel expenses like side gig software, rental maintenance, and suddenly profit stream is obvious. No extra math, no spreadsheet gymnastics. 2 bonus tips that made everything click for me. Bonus tip number 1, the 3-bucket rule. Before you ever look at the category list, ask this. Is this an asset, a liability, or an equity? That's it. Every transaction lives in one of these 3. Asset, something you own or control with future value. Examples, cash, bank balances, equipment, inventory, money someone owes you. If it sticks around after this month, it's probably an asset. Liability, something you owe. Examples, credit cards, loans, payroll taxes, sales tax payable. If it creates future pain, congratulations, liability, equity. This is the ownership value. And here's the simple version. Equity changes when the owner puts money in, the owner takes money out, the business earns profit, the business runs at a loss. Revenue increases equity, expenses decrease equity. So when you categorize something like sales, that increases equity. Rent expense, that reduces equity. Owner contribution increases equity. Owner draw decreases equity. That's the game. Categories like advertising, software, or meals are just how we track how equity changes over time. That's it. And once you realize that expenses are just reductions in equity, the whole system feels less mysterious. Bonus tip number 2, the 5 ways money actually moves. This is the second mental model that makes everything click. Money only moves in 5 ways. No exceptions, no mysterious transactions. Money in, cash comes to you. Sales, refunds, owner's contributions. Money out, cash leaves you, paying bills, buying stuff, subscriptions. Money transferred, money moves between accounts you already own, checking to savings, bank to credit card payments. This is not income and not an expense. It's just a reshuffle. Money owed to us. You earned it, but you don't have it yet. Invoices, accounts receivable, and money we owe. You spent it, but haven't paid yet. Credit cards, bills, loans. And here's why this matters. If you're stuck categorizing something, it's usually because you skipped this step. Once you know which of the 5 moves is happening, you're choosing between 2 or 3 options, not 30. Part 4, Designing Better Categories. Here's how you avoid category explosion. Instead of adding more categories, add dimensions. That means tags, notes, or short descriptions. Example, tag by person, kids, partner, you. Tag by project, vacation 2026, wedding, move. Tag by payment method, credit card A, cash. This lets you slice the data without destroying the chart of accounts. Another underrated move, track your regular but predictable expenses separately. Stuff like annual software, insurance paid every 6 to 12 months, memberships. Create a category group just for those. Why? Because it spreads the pain. Your monthly reports stop lying to you, and you stop being surprised by bills you knew were coming. Also, watch for shadow lifestyle creep. That's all the small recurring charges under $20. Apps, subscriptions, random tools nobody remembers signing up for. Once a quarter, scan them. You'll almost always find easy savings. Part 5, Reviewing like a pro. Last piece, and this is where good bookkeepers separate themselves. Categorizing isn't done when the transaction is assigned. It's done when it's reviewed. Build a simple monthly ritual. 10 to 15 minutes, same process every time. Example, confirm everything is categorized. Look at the top 3 spending categories. Ask, is this what we want our money to be doing? Adjust one rule, habit, or category for next month. That's it. Not complicated, not fancy, but super effective. Conclusion, if you remember nothing else, remember this. Categorizing transactions isn't about getting the right answer. It's about building a system that gives clear answers to real questions. When you do that, your books stop being stressful and start being useful. And that's when you actually look smart.